Which fund would have made you more money if you put $10,000 into it? SCHD or VOO? I've collected all of the data over the last 14 years for both and simulated this, and the results are very interesting. Both of these ETFs, or exchange traded funds, are incredibly popular online. SCHD is known for impressive dividend growth, while VOO has built a reputation for consistent long-term returns. In this video, we'll dive into key metrics like their past and current performance, dividend payouts, and a side-by-side comparison to see how each could have performed if you put $10,000 into it. Let's take a look at our first competitor, SCHD. This fund is owned by Charles Schwab Asset Management Group, and this is their Schwab US Dividend Equity ETF. Their objective is to track the total return of the Dow Jones US Dividend 100 Index as close as possible. This fund holds over 100 large cap companies that are all part of this Dow Jones Index, and they also pay a dividend of about 3.5%, which is the main focus of this ETF. They also have a very competitive management expense ratio of about 0.06%, which works out to about $6 per year for every $10,000 invested. But cheap doesn't always mean better. So what else does SCHD bring to the table beyond its low fees? Now, the holdings are a very important part of this fund, as SCHD recently made some huge changes in Q1 of 2025. They removed and added some key holdings, changing their sector breakdown. Right now, SCHD's top 5 holdings are ConocoPhillips, Chevron, Verizon, Coca-Cola, and Bristol-Myers. With these holdings, their top sectors are now energy at 21%, consumer staples at 19%, and healthcare at 15.3%. But SCHD's real claim to fame is how consistently they have rewarded investors through its dividends. Let's take a look at their impressive dividend history and growth rates. At face value, SCHD's 3.5% dividend might seem rather modest, but when you dig into their dividend history, you start to see the bigger picture. They've been increasing their annual dividend by about 10% every single year. That's not something you see often, especially from a fund with over 100 large cap companies. Now, let's take a look at VOO, a fund known for pure growth, and can it really compete with SCHD's dividend-focused strategy? VOO is Vanguard's S&P 500 ETF designed to track the performance of the S&P 500 index. This represents the 500 largest US companies. It offers a modest dividend yield of around 1.2%, but the primary focus is on the price appreciation. VOO also has a highly competitive management expense ratio of 0.03%. This works out to be about $3 per year in fees for every $10,000 invested. But why is VOO so popular among investors? The appeal largely comes from its historical price appreciation. The S&P 500 index, which VOO tracks, has historically returned between 8 to 10% per year. While SCHD focuses on dividends, VOO's growth comes mostly from this capital appreciation. So what are the individual companies driving VOO's growth? Some of their top holdings include Apple, Nvidia, and Microsoft, each making up around 5 to 7% of the ETF, and Amazon and Meta follow at 3 to 4%. But the sector concentration is quite different compared to SCHD. In VOO, technology makes up approximately 30%, financials around 15%, and consumer discretionary and healthcare both around 10%. Although VOO's dividend yield is relatively low at 1.2%, there's still some appeal here, and that comes from its dividend growth rate. Over the last 5 to 10 years, VOO has managed about a 5% dividend growth rate, which is impressive for a fund that focuses on price appreciation. But with all of VOO's growth potential, can it really outperform SCHD's impressive dividend strategy? Let's compare them head to head. Now we've got all of the historical data laid out, so let's put these two giants to the test. We'll start with 2025 and see how things are performing in the short term. In January 2025, SCHD was trading around $28 per share, and a $10,000 investment at that price would have given you roughly 357 shares. Throughout 2025, SCHD remained relatively steady, trading at $27.75 by March. Considering all of the economic uncertainty, especially with tariffs being a common topic, that's a pretty stable performance. SCHD pays dividends quarterly, and in March they declared a dividend of 25 cents per share. That would translate to a payout of around $90 in this simulation. So in just a few months of 2025, your SCHD position would be up 0.9% or $90, with most of that gain coming directly from dividends. Now let's shift our focus to VOO. VOO started 2025 on a high, trading around $558 per share. A $10,000 investment at that price would have given you roughly 18 shares. However, with the ongoing global uncertainty, especially with those tariffs, the S&P 500 has felt some pressure. By March 2025, VOO has dropped to $510 per share, and they did declare a dividend, but the payout was only $30. That puts VOO's total return for 2025 around 8% in the negative. It's important to remember that this is a short time frame, but it highlights how volatile markets can be, especially during uncertain periods. SCHD seems to be holding its own, while VOO is feeling much more pressure. Now, it might be a bit harsh to compare these funds based on a very short 3-month period. So let's run through the data on a $10,000 investment on each fund since they were both brought onto the market. SCHD was brought onto the market in late 2011 for a price around $8.33. A $10,000 investment would have returned around 1,200 shares at the time. Now, if we fast forward to the 10-year mark in 2021, there is some significant growth. SCHD is now trading around $26 per share, and dividends would have returned around $6,700. This would make the total return around $39,000 or 390% in just 10 years of this investment. Now, as we look at VOO, something we should mention here is SCHD was brought onto the market in 2011, so to be consistent, we'll use VOO's price at that same time. So during 2011, VOO was trading around $111 per share, and that $10,000 investment could have returned around 90 shares. Now fast forward to the 10-year mark in 2021, and VOO is now trading over $421 per share. Don't forget about the dividends, as they would have returned around $4,300, and this would make the total return around $40,000 or 404% after 10 years of this investment. So far, VOO is slightly ahead of SCHD's performance during this time, but let's see how things play out as we fast forward to present day in March 2025. Now back to SCHD, they are currently trading around $27.75, and the dividends have been stacking up over the last decade, representing about $12,000 of the total return. If you include the share appreciation, SCHD's total return would have been $52,000 or about 525% during this time period. Now let's see how VOO compares. VOO is currently trading around $510 per share, and they have accumulated about $6,600 in dividends over the last decade. The total return comes out to $55,000 or 550%. So VOO actually comes out ahead of SCHD in this time period, but overall the results are pretty close. Both of these ETFs have shown strong performance over the past few years, and when we visualize this performance, it's clear they're both appreciating quite well. It could be pretty hard to pick between the two, but let me know in the comments below what you think of these ETFs. If you did enjoy this video, I've done similar past performance reviews on the channel, and I'll link 2 of them here right now on the screen. Remember, past performance does not have any guarantees on future results, so although this video can be very entertaining, no one knows how the future performance will play out. As always, thanks for watching.